Well, today I want to talk about special purpose acquisition companies again. Now, I had a previous video where I talk about what they are. You can check that out if you follow this link here. Today, I want to talk about kind of their origin story, some criticisms of them. Now, as I mentioned previously, they are surging in popularity. 2020 was a massive year for SPACs. About 15 years ago, they also had a brief surge. They kind of went away. We can compare the SPAC IPOs to the overall IPO market. And we can see that, yes, in fact, SPACs are growing. Their issuance are growing faster than traditional IPOs. The question I have, of course, is, are these good investments? Are these safe investments for the people who want to invest in SPACs? Now, they started off called blank check companies in the 1980s, and it was a disaster. It was really just riddled with scams. I mean, the very structure of these things is where you give me money. I'm not even going to tell you what I'm going to do with it, but you give me money and I'm going to find a way to invest it. So a lot of people got just totally hoodwinked there, where scammers just kind of took their money. Today, the thing is there are some protections there, but it is still a situation where you really don't know what you're investing in. You're just hoping that this guy, this team, whatever, this gal can find a company to acquire and that you're going to make some money off it. So there is still a lot of potential there for fraud, even with kind of these improvements and regulations around, surrounding these companies. So be careful of that. Now, the other thing you have to be concerned about is like what you're actually getting. So as a SPAC shareholder, you can buy, and it's $10. And for $10, you get one share of the SPAC. You also end up getting a warrant to buy another share for $11.50 at a later point. But that's kind of the typical structure there. But that doesn't mean that you're going to get, let's say you buy 10% of the SPAC shares. Doesn't mean you're going to get 10% of the company that ultimately ends up being acquired. So the SPAC shareholders do get something, but the SPAC sponsor or the managers of the SPAC get a big cut. The company that the SPAC ends up acquiring, the company founders, they're not giving up all of their equity there. It's just like any other IPO. And they're also PIPE investors. Now, I'll have another video at some other later time where I talk about PIPE investors. But ultimately, with this structure, a recent example in the news, the SPAC shareholders, they actually only ended up getting 1.4% of this company. When that merger takes place, then there's a transfer, of shares, and they ended up with just a very small portion of this company. So you really need to read the prospectus to understand what it is you're getting, because in all likelihood, you're getting just a very, very small portion of that company. There's the other thing in terms we talked about, kind of that what the sponsor gets. Well, it turns out they get 20% of the company for $25,000. And again, this is kind of built into the structure. That's how this works. So those managers of the SPACs get a massive component of the company. Now remember, the investors got 1.4%, and here the sponsors are getting 20%. So definitely understand what it is you're getting. There's also some dilution here. So there's a paper out there and where they studied SPACs in general. And in general, for every $10 invested in a SPAC, the SPAC in the end only has $6.67 worth of that $10 left in cash. This is kind of built into the structure of SPACs. And what it really is that's kind of the cost to get this deal done. And it's all being subsidized by the SPAC investors, okay? That's just and they're subsidizing, both the sponsor and the company that's being acquired. There's also, as I mentioned, these warrants that, if exercised, will further dilute, the value to SPAC shareholders. The other thing is, are they good investors? Well, it turns out they aren't. So there's some high-profile, hugely successful stories like DraftKings, but in general, these are losers. So on the average return that you get investing in a SPAC is negative 1.4%. That compares very unfavorably to the typical return you get for a standard IPO, which is positive 49%. Huge spread there, really not that attractive on average. And even here, you can kind of see even the big winners are less than the average for a traditional IPO. So again, probably not the best investment in a lot of ways. Ultimately, I'm not sure these are much more than wealth transfers, and the people that invest in SPACs in general would be better off putting their money in a mattress or earning 0.000% in a risk-free asset. So I'm Brian Kozlowski. Thanks so much for listening.